Now we come to part of the show that we have on a regular basis where I talk about top 3 things that I think individual investors should consider before they make their investment decisions over the next couple of weeks. Number one, as you can see here, investors starting to chase the hot stocks. More and more, I'm receiving calls and emails, messages talking about what's going on in the tech space and artificial intelligence and what's with this name, NVIDIA. People can't even pronounce it, to be honest with you. They don't even know at times what the stock actually does, what they do, that they produce chips for artificial intelligence, but they just know they're considered an artificial intelligence stock and they want to buy it no matter what the price is. And they're looking at all the chip makers and all the different tech companies and looking at just chasing these companies to the moon. They don't care about valuation. They just want to get in. And so I think you need to be mindful of that. Second thing, along the same lines and stemming from investors chasing hot stocks, would be stay diversified. It is very important for individual investors to stay diversified at this point in time. You don't want to have all your eggs in one basket. You want to be nicely diversified. And last, or the third point, economic data. We always want to look to the economic data. As I mentioned in the last segment, briefly, we're going to get 2 pieces of economic data in the next couple of weeks. This Friday will be PCE, personal consumptions and expenditures, which is a measure of inflation in the US. Interesting enough, the data will come out on the last trading day for the quarter, on the last trading day for the month, on the last trading day for the first 6 months, the halfway point in the year. So it could be potentially a big market mover come this Friday. We're also going to get, not this Friday, but a week Friday, we're going to get jobs data out of Canada and the US. Obviously, a very important number. We want to see job growth, but not too much growth. That Goldilocks type of scenario, not too hot, not too cold. So let's talk about the first point, which is investors chasing the hot stock. And I thought we'd start off with, you see here, the AI. I thought we'd start off with probably the hottest stock on anyone's list, which is NVIDIA. We have a chart on NVIDIA. And I thought this chart to be quite interesting. This is roughly a 1.5-year chart. It starts on January 2023 up until now, so 1.5 years. You could see NVIDIA in the last 1.5 years up over 800%. 800%. Stock trades somewhere around 45 to 50 times forward earnings, so getting pricey once again. At one point, not too long ago, it was trading, in and around 40 times earnings once it started to really gain some momentum with its earnings. Another chart that we have on NVIDIA showing once again how powerful and how much NVIDIA has gone up with respect to its revenues. Look at these numbers are in billions of dollars. Their net income in billions of dollars. So revenue on the left-hand side and net income on the right-hand side. And the results have really soared, really, since the talk about artificial intelligence, since ChatGPT came out onto the scene and many people started wondering what this all was about. NVIDIA came out and said, we have the best chips in the market today, and that has proven to be correct. They still dominate the marketplace for artificial intelligence, and it is an unbelievable stock. It's been an unbelievable performer. Actually, I want to go back to the last chart just briefly, if we will, and you're going to see here, even though NVIDIA has been up 800%, you see the line at the bottom there, that's the S&P 500, and one would say, well, that's a pretty flat line there. But understand that the first line is 100% return. So you could say that the S&P 500 is up 40, 50% in the last year and a half. Unbelievable for the S&P 500 to be up that much in the last 18 months. But yet when you compare it to some of these tech stocks like an NVIDIA or like some of the other chip makers, it's not even close to comparing. These chip makers are blowing it out of the water. NVIDIA is just unbelievable. And so when you compare it to the S&P 500, there's really no comparison whatsoever. Let's fast forward again to what I wanted to look at, which would be the Mag 7, a chart on the Mag 7. I think that it all started with the Mag 7. And again, this is the area that people are chasing, right? They want to buy the big cap tech names. And as I've said all along, and as I will say right now as well, I think you need to own some of the big cap tech names as part of a growth portfolio, but you just don't want to chase some of these names at all costs. You don't want to chase some of the big tech names at all costs. And you can see how well the Magnificent Seven, that actually includes Tesla, which unfortunately hasn't had the best run as of late. So which names out of these big cap tech names can you look to buy today that aren't exactly as expensive as some of the other ones? And I go to three names, two names that are quite cheap, and one name that I think has tremendous momentum and I think is going to go higher, even though it's not as cheap. First name I want to bring up is Alphabet. I've talked about Alphabet or Google many times on the show. You can see here the chart has been tremendous. It has performed extremely well, really, since last November. So the last, let's call it 8 months or so. It's been a great performer. But again, stock trades 23, 24 times forward earnings. Not that expensive when you can look at what its growth rate is doing right now. Another name that I've spoken about, again, on this show many times is Meta, or formerly Facebook. Again, another name trading at 23 times, 24 times earnings, growing at a much faster clip. There's talk that Meta is going to have some sort of contract with Apple be announced shortly regarding their artificial intelligence. And there are a lot of talk right now with Apple and Google, or Apple and ChatGPT and Microsoft, and Apple and Meta, all these big cap tech names getting together to bring us, the consumer, the investor, all the information and the ability to use their products and provide us better, faster, and stronger products. So it's interesting what's happening, and Meta, I think, will be rewarded if they were to get some sort of deal or make some sort of deal in that capacity with any company down the road. But overall, Meta's business is fantastic. As I've said many times, almost 3 billion people are on Meta apps every day, and we know there's only 8 billion in the world today. So you're looking at almost half the world on their apps at any given point in time. Lastly, Amazon. A name like Amazon, not so cheap, trading at a high valuation or higher valuation, valuation in and around where Nvidia is trading, maybe even a little bit higher. But I think Amazon has a lot going for it right now with its AWS, its cloud business, its obviously retail business, artificial intelligence. It's got everything, and it's got tremendous momentum. I think this name, for those of you that can handle the risk of owning a name like Amazon, I think this name does go through $200 a share and beyond at some point in the not so distant future. So overall, I think you need to own some of these big cap tech names, but in my opinion, I just don't think you need to chase some of these names. So if you see stock prices really moving far to the upside, stay disciplined, stay with the ones that make sense from a valuation basis, good quality names, but stay disciplined. Second point on our list of 3 that I think individuals should consider before you make your investment decisions is this idea of diversification. You want to stay diversified. Yes, tech, like in 2023, is leading the way in 2024, but you never want to put all your eggs in one basket. And for those of you that don't have a big enough or large enough portfolio to go out and buy names in all the different sectors of the market, names or buy different corporate bonds, provincial bonds, money market products, ETF, bond ETFs, stock ETFs, basically build up a portfolio diversified in many different areas. Well, the way you do it is to manage product, ETFs or mutual funds. Our first chart here is a pie chart, and it's just an example of what mutual funds do. So they basically divide up the basket of money that they take in, and they'll buy some real estate, some government bonds, emerging market stocks. They'll buy some large cap Canadian stocks. They'll buy some middle of the road sized companies, domestic bonds, international stocks. So through a mutual fund, you can be nicely diversified. So for all those that have smaller portfolios that want to stay diversified to protect their portfolio, because we know diversification is the best way to protect a portfolio, not having all your eggs in one basket, having it in a few different or a bunch of different baskets makes sense, right? If something goes down, the hope is something else in the portfolio rises. And with a mutual fund, that definitely is the case. So you tend to see mutual funds, depending on what type of mutual funds, but for the most part, mutual funds do not move as quickly as individual stocks will. Overall, they tend to move a little bit slower. They are diversified in many different areas, depending on the mutual fund that you buy. And it's always a good idea to be diversified. The next, chart that we have here is one on Gilead Sciences. And this is a name that I wanted to bring up because I get a lot of individuals that own stock portfolios with me for the most part, stock. They may own some bonds as well. But they'll say to me, Alan, why do we have any names in pharmaceutical? With the exception of Eli Lilly, which has done tremendously well this year. They'll tell me, why do we own a name like Gilead? Why shouldn't we take that money and buy something in the tech space? Because that's moving a lot quicker. Well, I guess they have a point there. But then you get a point in time like Gilead. Gilead had, unfortunately, not the greatest run for the past year. And actually, the next chart we can show, let's go to that chart just quickly before we go back to this one. You can see the slope has been to the downside for the last year, no doubt about it. But you can see here on the far right of this chart, a nice steep rise in share price. Now, if we go back to the chart prior, this is a 1-month chart, and you can see definitely the Gilead. Let's go back one chart. You can see the rise and how pronounced it is. There it is. And they came out recently with a drug in the HIV space to manage HIV. And obviously, it's in its infant stages, but it garnered a lot of attention. The stock went from low 60s to mid 70s in price in a matter of 2 days, 2 trading days. So my point in bringing this up is you never know when a stock is going to have its day. And at any point in time in 2022, tech stocks were the dog of the investment world. Nobody wanted to own them. Tech stocks were falling because interest rates were rising, and tech stocks tend to be interest rate sensitive. Well, in 2023, tech stocks were the best sector to be in. And 2024, tech stocks have done extremely well as well. So you never know. And so the idea to stay diversified, if tech stocks falter in the future, maybe pharma and bank pick up the slack. If pharma and bank are faltering, maybe tech stocks or retail stocks or oil stocks do well. So it's always good to have a diversified portfolio, even when names represent good value, but haven't, I guess, hit their stride yet, haven't showed their potential yet. You got to stay with those names, especially if they're good quality. And the last chart I have here for this, which is this whole idea of diversification, is a chart about sector performance, the S&P 500 sector performance. You can see here all the sectors, or many of the sectors, if not all the sectors of the S&P 500. A lot of green numbers to the right, 1-year numbers, S&P up 24.5% on a whole. But you can see consumer staples up 7%, materials up 11%, industrials up 17.5%. 43% gains for S&P information technology sector. So you can see all these different sectors that I believe investors, wise investors, savvy investors really want to be in if you have a nice diversified portfolio. The last point I wanted to touch on that individual investors should consider, as I said off the top of the show, is economic data. We're going to get economic data, PCE, coming out this Friday. We're going to get jobs data coming out in, I guess, a week Friday. And we have our first chart on PCE. You can see here, which is personal consumption and expenditures. It's a measure of inflation. It actually doesn't factor in real estate or dwelling or housing prices as much. So I think the Fed likes this one a little bit better. You can see it's popped up to 2.7% from about 2.3%. But the interesting thing or interesting stat here is that PCE averages over the last, well, this chart shows it, or since, I guess, coming up from 1960 to 2024. So what is that? That's about, let's call it 64 years. PCE averages about 3.3%. And here we are at 2.7%. So below the average. And so I think the Fed is happy to see PCE coming down and staying down. The next chart we have here is on jobs. I wanted to throw that one up. We've seen this before. Last jobs in May, 272,000, above expectations. But as I've said before, jobs is one of those things that I don't think the Fed minds seeing job growth. I think we can have inflation come down while job growth stays strong. And as long as we don't see wage inflation with that job growth, and I don't think we will, I think wage inflation is coming down. I think obviously we have a lot of people coming into the US, coming into Canada, which has helped, perhaps distorted some of the jobs data, some of the jobs numbers, and maybe even some of the inflation numbers as well, with all the immigration coming to North America as a whole. But overall, I think we can still see good jobs numbers and still have inflation come down. So overall, those are the three things I think individual investors should be considering before you make your investment decisions. And as I said, we're going to get some good economic data, some good data points. You got to stay diversified and don't chase those high flying stocks. Stay disciplined, stay with good quality. And if you do that, I don't think you can go wrong.